This is Jeff Shaw. I'm with Century 21 in Tampa, Florida. I get questions occasionally, is it better to rent a home or is it better to buy a home? Well, I'm going to walk you through a little scenario that will help you make up your own mind about what's better for you personally. And this is a real life scenario, real prices, so we'll see what the numbers come out to be. But let's say you're in our market and you purchase a home for $115,000, which is certainly doable. You're going to put 5% down. So that means you're going to finance about $109,250. Okay, closing costs will be around 3%, so it's about $3,200. We'll assume no other expenditures. Well, we can put in, okay, you have to buy a range. We'll put in $500 for a range. So out of pocket to purchase a home, you're going to need a cash outlay of about $9,853 ballpark. Okay, the mortgage amount, $109,250. That's 30 years. Interest rate, let's say 3.75%, which is reasonable in today's market. That's a principal and interest payment of $505.95. Ad valorem taxes, we're going to estimate, and this is without homestead exemption, we're going to estimate, so they'll really be on the high end, $2,875. Typical subdivision down here, no CDDs, but some of the subdivisions have CDDs, so you would have to pay attention to that as well. Insurance, let's say $650 ballpark. So your monthly cash outlay here, principal, interest, taxes, insurance, you're at about $799.70. But we have to take in the tax effect of home ownership. So if you add the tax deductible items back, which would be your interest and your property taxes, and let's say you're in a 25% tax bracket, your tax savings is going to be $1,734 back into your pocket at the end of the year. That's $144 a month that you get back on your tax return at the end of the year. So your net monthly out-of-pocket cash is going to be $655 a month. Now for rent, I put in $1,200 a month, which is certainly reasonable. That's going to give you a monthly savings of $544.83. It's a lot of money. Multiply that times 12, your annual savings is $6,500. Your reduction in your mortgage balance and your debt, you're going to pay $2,008 against the principal. So that amount is going to come off the debt. So that will basically be an increase in your net worth at the end of the year. And let's assume that the property is going to appreciate 1%. It could be flat, it could increase 2%, 3%, but what we have started seeing this year is we have seen property values this year start to go up because of the shortage of inventory on the market. So your increase in your net worth at the end of the first year is going to be $9,696. Your original cash outlay was $9,800. For all practical purposes, you laid out cash at the end of the year, but your net worth went up by the same amount that you had your cash outlay for the first year. Now, if you go to your second year, then you've still got this much of the cash benefit pretty much. Third year, same thing. So overall, on an annual basis, you're about $9,600 per year better off to purchase a home. And that's, like I said, that's going back up here, and that's assuming that on your ad valorem taxes up here that you don't even have homestead exemption. We know that that won't be the case. If you have any questions or you would like an agent to sit down with you and actually do an analysis on a specific home, you can contact me or contact any of the Century 21 Shaw agents, and we'd be happy to help you with that. Thank you so much and good luck.